Hello there everyone, first in a series of videos taking a deep dive into the various pronouncements of this week's budget. The first one all about business asset disposal relief. So if you are an entrepreneur looking at selling shares in your limited company, you're manufacturing your widgets and you want to sell out, what are the capital gains tax implications of selling? What's your likely capital gains tax bill going to be given the increase in capital gains that was announced in this week's budget? So I've just thrown together some numbers. Now, assuming we've got one guy and he's a sole director shareholder, he's used up his personal capital gains tax allowance, which is pretty negligible anyway. It's almost like a rounding in the calculations. It's only $3,000, but anyway, he's got no personal allowance for capital gains tax. He's going to pay CGT at the rates in force at the time on his consideration, which let's assume is £2 million. So he sells his widget making limited company to a competitor for £2 million. So what if this guy had sold the shares in the limited company on Monday this week, i.e. before the budget? Well, 2 million, he would have got the first million at 10% tax, then the next million at 20% tax. So he'd have paid capital gains tax of 300,000 on 2 million receipts. That's an overall effective tax rate of 15%. Now, what if he sells his business today? So we're talking after the budget now. Now remember, what's happened after the budget has been an increase in the main rate of capital gains tax from 20 to 24. But for the business asset disposal relief on the first million, it remains at 10% for the next few months until the end of the 24-25 tax year on the 5th of April 2025. So let's assume the same guy, he didn't sell his business on Monday, he's selling it today. On Friday, after budget day, what's his capital gains tax bill? Well, £1 million, first million at 10%, no change. Second million of the 2 million that he gets is at 24%. That rate increased overnight on budget day from 20 to 24%. Crunch the numbers, he's got a tax bill of 340,000. So it's an extra 40 grand in capital gains tax if he sells today as opposed to 3 days ago. That's an overall effective rate of 17%, i.e. 340,000 on 2 million, 17%. All right. Now let's assume that this guy can't get a deal away this tax year. He's in protracted negotiations with a competitor, and let's say he sells next summer, summer 2025. What's his capital gains tax bill? Well, the first 1 million, the rate increases from 10% to 14%. Now it's still below the main rate, but obviously 14% not as good as 10%. And then on the next £1 million slice of the 2 million, we're looking at the main rate of 24%. So 1 million at 14%, 1 million at 24%, overall tax bill of 380,000. So now his effective tax rate 19%. So he's got to shell out 380 grand when he gets his 2 million in capital gains tax. Right. What if, again, this guy can't get the deal away until the following tax year? So from April 2026 onwards. So let's say he sells this thing in 2 years' time. What's his CGT bill going to be? Right. Well, the first 1 million, that is now taxable at 18% at that point. So remember, it started out at 10%, then went to 14, then went to 18. So the first million at 18, the second million at 24. That's a CGT bill of 420 grand on 2 million proceeds. That's an effective rate of 21%. So you can see the timing of this sale of this business. Had he have done it pre-budget, he'd have had a tax bill of 300 grand. Had he have done it between the budget and the end of the tax year 24-25, tax bill of 340, selling it in the 25-26 tax year, tax bill of 380, and then selling it from April 2026 onwards, 420,000 tax bill, effective rate of 21%. So a big difference in these numbers. So the tax bill goes from 300 grand at the start of the week to 420 grand in a couple of years' time. That's the impact of the budget announcements on capital gains tax for those selling businesses who have potential business asset disposal relief available, which is having some of the proceeds taxed at the lower rates, which are going up. So 10%, 10%, 14%, and 18%. So here's a little alternative that you can do to mitigate that increase rather than selling the trading business that you built up over many years. What if you do this? Insert a top co above the trading co. Hold that for the requisite period of time. So you've got to hold that for 12 months, have that structure in place, and then sell the trading company. Now, what would happen in that situation? Well, if you have a holding company above your trading business and someone wants to buy your trading business, where does the money go? It doesn't go to you as the shareholder because you don't own the trading company. Your top co, your hold co owns the trading company. The 2 million would come into the top co. Now, there's a rule called substantial shareholding exemption, which says that when a top co disposes of a subsidiary co, trading co, that capital gains tax is zero. Zero. So no CGT bill. So over here, 420 grand capital gains tax bill. If you do this, zero capital gains tax bill. Yes, there are funds then in a company, but the whole point is if you're going to sell out for a boatload of money, what are you going to do with the cash? Assuming you're quite savvy and you're not going to blow it, you're going to invest it. Now, where are you going to invest it? One of the best places is in a limited company wrapper to make use of corporation tax rates versus income tax rates. So if the money was going to end up in a company, or a lot of it in a company anyway, from an investment point of view, well, here you go. You've already got the thing set up to begin with. So, but there's no capital gains tax. You've saved 400 or 1,000 just by having a topco and then using that topco to invest in whatever you like. There's no restrictions like there would be in, say, a pension, assuming you've already got a pension as well. But there's all sorts you can do with these topcos, and saving capital gains tax on the sale of a trading subsidiary is absolutely one of them. That's a bona fide planning that is certainly currently it's available. Substantial shareholding relief hasn't been curtailed or binned off by the government. It's been around for several years. So that is something to think about to mitigate capital gains tax when you sell your business, put it in a holding company. And then you might say, well, Simon, what if all this money is trapped in a company? Well, yes, but that's the point. You don't need your hands in your back pocket of £2 million. You might need an income from that to live on. Well, that's fine. Then you pay yourself dividends or salary, whatever it is from there. But you have avoided a serious capital gains tax bill. Anyway, I've done videos on these before. Probably will do again in the future. But just an overview there on capital gains tax, changes to business asset disposal relief. You're an entrepreneur. You're thinking of selling your shares in your limited company. This is the tax that you could be faced with. If you like this video, please do subscribe. And as always, I'll see you soon.